In this video, I'm going to show you how to find the best time of year for your trades, and I'm going to show you the best way to take advantage of that information. I'm going to show you step by step what I did, and I'm going to show you how you can do it yourself. Stay tuned. My name is Mark from Tradinformed.com, and I have been backtesting and trading for years. I mostly do backtesting in Excel, and I have found all sorts of information. I like to share my analysis here to help traders like you improve their results. In this video, I will show you two models. The first model shows you the best time of year to trade, and the second model shows you how to take advantage of that information. Let's have a look at the first stage of the analysis. Here I have the weekly analysis model on the screen. So this is a very simple model, and it's simple for a reason, because I want the results to shout loudly. I want to be easily able to understand what they are telling me. So first of all, I'm not using any other closing mechanism apart from a time close. So I'm testing here on the daily time frame, and I'm using 30 days, 30 bars. So each trade will close after exactly 30 bars. Now you can set the week number here. You can see me indicator. I can say week 1. If I say week 1, you can see that it is January, first month, and the second. So January 2nd, that's just a typical day. You can see why that I've got this if we go to say to week 12, and you can see it's March 13th. So 26th, June the 19th. So that is just a simple way to very quickly see which week is being tested. So, of course, it would be very easy to manually go through each of these numbers, but what I have done is use the optimizer. This is a feature in all Tradinformed backtest models, and all I am doing is going through each week consecutively. Now, all I need to do is set the initial value, the final value, and the step value. So, click Optimize. I've got the results here. I have sped that up, but it doesn't take very long. And what we get is a very nice, easy to read visual representation of an entire typical trading year. So with greens showing the higher net profit and reds showing the lowest. You can see we have a burst here between weeks 10 and 14. And if I scroll over here, you can see the time period that we are currently coming up to as I record this video. We are in approximately week 37, week 38, second week of November, but it doesn't matter. All this analysis applies to the entire year. You want to be aware of when the strong, traditionally strong parts of the year are and when the weaker parts of the year are. So coming in here and starting at about week 40. Now, if I go back here, you can see week 40 corresponds towards the end, maybe week 4 of September. Go back to the optimizer. See week 40, week 41, it's looking darker green all the way, really up until quite advanced into December. But the period of time that I'm looking at in particular is here. So weeks 41 to 48, roughly late September all the way through October and well into November. These are the best. On a 30-day basis, these are the best and strongest trading weeks. In a moment, I'm going to show you the next version of the model, which is based on the same template, but it goes into more detail and turns this analysis into something closer to a trading strategy. So stay tuned for that. I've taken the information that I got from the first model, the simple model, and put it into something that is a little bit more complex, a bit more nuance in it. So I've taken those weeks that I was referring to. Weeks 41 to 48 are the time that I'm going to be opening a trade. Now, there are some things we can do. We can see the net profit here. We can see we've got 80% winning trades. Compound annual growth rate is not strictly relevant here because we're only trading in part of the year, a fairly small part of the year as well. So let's see what we can do with this model. First of all, what we can look at is increase the length of time to potentially hold the trade. So I'm going to push that up to 300 so the trades can stay open for much longer. You can see immediately, unsurprisingly, we've had a big effect on the net profit. What else can we do? Well, we can add a profit target. Now I'm using the average true range here to set profit targets. So if I want to set the profit target to 5 times the ATR, 6 times the ATR, etc., we can do that and very quickly scroll through. Another thing we can do is add some more exit conditions. So we've got a profit target. Stop loss is not currently active. We've got another one here. We've got a time close. I'm going to introduce 2 more. Now these are what I refer to as a strength close. It is a way of exiting a trade when things are going well, when we've got some exuberance in the market. So first one of these closes the trade if it is in profit. 3 consecutive bars of at least this percentage gain. So that wouldn't be too bad on the SPY if you're familiar with that. 3 consecutive days of at least 1.25%. Now this close here works the same way, except this only applies when the trade is currently in a loss. So 2 consecutive bars at 1.25%. These are both a way of getting out of the trade when things are going relatively well, as opposed to a stop loss, which gets us out necessarily and correctly when things are usually going badly. So it's an alternative approach. You can see here, slightly higher net profit. Now there's many other things we can do, but there's a few things that I have looked at in this analysis that are particularly pertinent to 2021 and no doubt will apply to other years as well. So first of all, a condition that I've used many times before, and this is to enter on a lower close. Very simple, particularly for the SPY, which tracks the S&P 500. It does tend to retrace and often gives us a buy the dip style entry. So if I check this, the strategy is only going to enter when all the conditions are met, plus the close is lower than the previous close. Now we've got 2 other things here, and both of which specifically apply at the moment. The minimum gain from the start of the year. What would prevent us from trading this strategy? Thinking that these conditions, which I've specifically set for end of September, October and into November of the year. Well, for a start, we're up very nicely from the start of the year. So we're in a strong position. So I've set here a filter for the minimum gain from the start of the year. So this, when I check this box, what it will do is filter out all the trades that apply in years when by the time of the entry, the price was lower than 10% from the start of the year. So at the moment we're around 20%. So we're much higher than 10%. So I'm going to check that. You can see, okay, we have a lower net profit. That's to be expected. But percentage winning trades, I'm going to check it on and off again. You can see it's actually slightly higher. So we are losing some trades. We've got a smaller sample size. That's always important to be aware of. So I can put this up to 15% or even 20%. And you can see on the basis of these statistics, we've really got a bit of a negative result. Maybe a slightly positive one, depends on your perspective. But when we consider the minimum gain from the start of the year, according to these results, it doesn't matter if we've already had plenty of gains. We can still expect a good result. Okay, the next one that I've programmed in here. Now, don't forget, this is in Excel. And if you had this model, which you can get, all you need to do is sign up as a Tradinformed member. You would be able to do all this yourself and more. So minimum retracement from recent highs. This was another thing that I was thinking of. A lot of people, myself included, sometimes concerned about buying near highs. Now, with some obvious justification, very often buying near the highs does not get us value. However, particularly in momentum style conditions, but also just very often if markets are doing well, the likelihood is they will continue to do well. Can be difficult to convince ourselves of that, but in this case the statistics back that up. So minimum retracement from recent highs. What that means is the closing price should be no greater than 4% lower than recent highs. Now, I've defined recent highs as a high price over the past 45 days, which is really 2 trading months. So no lower than the high. So that feels quite stringent. No lower than 4%. So surprisingly, to me at least, it didn't make a lot of difference. So we have to make it more stringent. 3%, 2%. You can see here what I'm getting at. There's not a lot of difference. So within 2% of the recent highs, we're actually entering almost all of these trades. Percentage of winning trades is staying consistent as well. Yes, we're getting a smaller sample size, but the results are holding steady. So even more surprising to me, within 1% of recent highs, we're still getting most of these trades. We're still getting 17 trades over the past. Let me see, out of 24 trades we were getting previously. So we're still getting more than half. So within 1%, at the moment, at the time of recording this video, we are closer than 1%. So rather surprisingly, that still holds true. Now, if I was to reduce that to 0.5%, you can see, well, we're getting fewer trades, but the results are holding very true. So here again, we have a negative result or a positive result. What we're seeing is that proximity to recent highs is not really affecting this. It's not really a big factor. Hope this video helps you with your trading analysis, and more importantly, it helps you with your trading to get better results. If you want to do any of the analysis shown in there, check out the link below about becoming a Tradinformed member. Please remember to subscribe to this video, hit the like button, subscribe to this channel for lots more content like this. And if you want more information about trading the financial markets, please go to tradinformed.com.